Hey.
All right. So with that, last and most certainly not least, and I don't know if he's here. I know they're both making their way up to the stage. Garry, did you get you back in here? And I know that active controller Shu. Oh, there he is. So let me give you, Mr. Controller, let me just give you kind of a little bit of a history lesson. So this is our 6th annual summit. I'm proud that in year 1, our first, our first get was Controller Tom Curry. And at the time, right, it was a very big deal for us. And it really, I would say, kicked off our first annual summit. And since that time, we have had the controller of the currency every single year. And so Keith Noreika, Joseph Otting, and now you. And so you're thankfully keeping our tradition alive. I hope Garry treats you right so we can get you back in the future. But again, thank you for your service and everything you've been doing.
Thank you. Those are big shoes to fill.
Well, thank you for joining us, Comptroller. I don't want to read off your bio. I think people can do that for themselves, but I thought I'd make a few observations. First, you and I think, are basically the same age. We intersected at Treasury on TARP, but I think we were on phone calls together, but never in the same room. And somehow you have a lot less gray hair than I have.
No, don't be fooled.
Well, whatever it is you've been doing, this is better than what I've been doing. But that leads to just, one of the remarkable things I wanted to point out to folks is, I don't think there's been a comptroller who's had as much experience across the system. So, SEC, Treasury, IMF, and Fed, many comptrollers, come from 1 or 2 places. So one, I think that for this moment in time, that's a very hopefully useful for you in terms of, the things that you have on your plate. And then the last thing I just wanted to note, for people who know me, I'm a finance history nerd, and I see Hamilton over your shoulder. In some ways, it's the most interesting time in banking, either since the end of the Second Bank of the U.S. in 1836 or the National Bank Act in 1863. I guess depending on what choices get made, the next 30, 40 years will look like one of those possibly. But between your experience and sort of that moment we're in, I assume it's a very interesting time to be comptroller. I know that the format of this is you're going to deliver remarks, but I just thought, putting in that context, that it's, as banking goes, this is one of probably the 2 or 3 most monumental moments for the United States in terms of how we're going to run a national banking system.
So Garry, I couldn't agree. Thank you for that really kind welcome. And yes, I do remember seeing your name on a lot of emails back in those days. And yeah, I think I've got a couple historical references I want to throw in there in my remarks to do today, and hopefully at the end we can catch up on some Q&A. So with that, maybe I'll just jump right in. I got my first paycheck. I'm gonna start with my first paycheck. When I got my first paycheck in 1989, bagging groceries at the local supermarket near my home in Columbus, Ohio. And it came on a printed check. And I remember riding my bike to the Huntington Bank branch around the corner to deposit it. And at the end of the summer, I had saved up just enough to buy a guitar, which I would have gladly bought sooner had I had access to credit. Today, if I were a teenager, I would be able to instruct my employer to direct deposit my paycheck straight into my PayPal, Chime, or Cash App account. No physical paper or bike ride to a bank branch would be needed. And I wouldn't need to wait to get the guitar. I could simply tap the buy now, pay later option or utilize one of the many credit offerings available. No bank would need to be involved, at least not apparent to me as the app user. The digitalization of banking has been underway for a while. Electronic payments began to dominate the landscape in the early 2000s, while banks developed online services to complement their traditional brick and mortar offerings. And Bitcoin launched in 2009, steadily attracting users over the next decade. By the mid-2010s, financial innovation was a prominent enough topic that agencies like the OCC and the UK's FCA began to explore ways to encourage responsible innovation. Then the pandemic hit and pulled the future forward. Several years of projected growth in digitalization took place in a matter of quarters. For instance, digital payments transactions increased 27% from $4.1 to $5.2 trillion between 2019 and 2020. Similarly, the total market value of crypto went from 200 billion in 2019 to 2.5 trillion today. Consumers and businesses everywhere experience greater convenience, expanded capabilities, and an increase in opportunities, all as a result of financial innovation. A closer, more objective look reveals a mixed picture, however. These trends are being driven by firms that are not subject to bank rules and do not have the same controls as banks. In regulatory speak, they sit outside of the so-called bank regulatory perimeter. The full implications of this will likely only become apparent over time. While the convenience and benefits of rapid innovation can be enjoyed immediately, the risks and harms to consumers and businesses of engaging in financial activities with fewer controls tend to emerge only later. Take, for instance, the Paycheck Protection Program. Fintech advocates proudly point to the role of fintechs in facilitating expanded access to PPP loans as evidence of their promise and value to society compared to traditional banks. More recent evidence, however, shows higher rates of customer dissatisfaction and of fraud with PPP loans facilitated by fintechs versus those facilitated by traditional banks. In the crypto space, the rapid growth of users and total market value has only been matched by the growth in scams and consumer complaints. Move fast and break things is a common mantra in tech. In the financial services context, it is important to remember that those things are people and their money. Increasingly, the three cornerstones of banking, taking deposits, making loans, and facilitating payments, are being reassembled functionally and digitally outside the bank regulatory perimeter by certain firms. As I will discuss in a bit, these so-called synthetic banking providers, or SBPs, operate out of the reach of bank regulators and free of bank rules, such as capital requirements, bank consumer protection laws, and the Community Reinvestment Act. History and research warn us that unregulated banking ends badly. Indeed, the origins of the OCC, Fed, FDIC, as well as many state banking agencies can be traced back to financial panics and destabilizing runs resulting from unregulated or poorly regulated banking. The ambitions of some of the larger financial services crypto firms to become universal, offering everything from crypto custody to retail brokerage, market making, asset management, also warrants attention. I mean, for starters, the rapid expansion and mixing of wholesale and retail activities at some crypto firms raises the question of whether there ought to be some kind of Glass-Steagall-like separation of activities in the crypto space, but I'll leave that question for another day. Many of these universal crypto firms hold themselves out as regulated, but this is a half-truth. Crypto firms today are regulated at most only partially and selectively, with no single regulator having a comprehensive view of the firm as a whole. Here too, history contains warnings, as I'll discuss in a bit. Without comprehensive, consolidated supervision, no single regulator can see the whole picture and understand how a firm as a whole operates and takes risk. This warrants greater attention as crypto firms, especially the universals, get bigger, engage in a wider range of activities and risk-taking, and deepen their interconnectedness within the crypto ecosystem and with traditional finance. To address the problems of synthetic banking and payments and a fragmented supervision of crypto, and to create an environment where responsible innovation can flourish, we need to level up banking and finance. I'm using level up in both senses of the term. That is, to increase something in order to remove a disparity, and to progress to the next level, which is a gamer term, which is common in my household. I've got 3 kids. We need to remove the disparity between the rights and obligations of banks and the rights and obligations of synthetic banking providers by holding SBPs to banking standards. At the same time, we need banks, fintechs, and crypto firms to step up and make the business of handling other people's money an ultra-high trust endeavor, where the needs of all customers are met in a reliable and consistently safe, sound, and fair manner. By leveling up, we can safeguard trust in money, lending, and payments, and ensure the public that financial innovation and change will not hurt consumers or endanger the financial system. Before banks get too comfortable, I feel it is important to note that I am not here to defend traditional banking and finance. Banks have been slow to adapt to change. Some groups, such as the underbanked, communities of color, rural communities, and small businesses have felt poorly served by the banking industry, and residual distrust from the 2008 financial crisis remains. These have created opportunities for fintechs and crypto firms. While banks have improved their financial conditions, risk management capabilities, and consumer practices considerably, Notable gaps, mistakes, and bad behaviors remain. I want to be clear. Everybody needs to level up, including banks. The biggest challenge with leveling up is that it cannot be achieved by the OCC or any regulatory agency alone. It requires a change in how regulatory agencies, including state regulators, interact and in how we define success. It requires less regulatory competition and more cooperation, less parochialism and more teamwork, less go-it-alone independence and more interdependence. It requires us to not cling to or fall back on the past, but to accept and adapt to the future. Put simply, we regulators need to level up too. My remarks today are focused on clarifying two key problems that need to be solved to ensure that we have a safe and sound financial system as digitalization trends continue to accelerate. As I will note in my conclusion, solving these should help modernize the bank regulatory perimeter and provide the clarity needed to facilitate responsible innovation going forward. So let me focus first on the first key problem, the digital unbundling and functional rebundling of banking. The core function of banking consists of three activities: taking deposits, making loans, and facilitating payments. Banks' role in providing these services together is what makes banks special, and thus needing supervision and regulation. The bundling of these three activities enables banks to intermediate credit, transform liquidity, and support the economy. It also makes banks highly leveraged, highly confidence sensitive, and highly interconnected. A run or stress at one bank can cause instability across the financial system. For these reasons, banks are subject to prudential regulations, like capital and liquidity requirements, and to supervision, which is unique amongst private corporations. In the early 2010s, companies like PayPal, Venmo, and Square began offering services and goods aimed at improving customers' payments experiences. Thus began the process of unbundling by peeling away the payments leg of banking. By 2019, the fintech payment space had grown significantly. The pandemic has only accelerated those trends. The proportion of digital activity originating outside of traditional banks has forced banks to adapt their strategies to compete. By and large, such competition has been healthy and beneficial for consumers and small businesses. The large payment fintechs have not stopped there, however. While they started off with a focused service or product, like facilitating peer-to-peer payments or connecting a credit card reader to a mobile phone, many have augmented their platforms and expanded into adjacent areas, such as extending various forms of credit and offering interest on cash held. Today, a range of fintechs provide seemingly the full suite of banking and investment services, including crypto, with the convenience of tech. These synthetic banking providers are reassembling the three legs of banking, but outside of the bank regulatory perimeter. One may be tempted to ask, so what? If fintechs can do banking better than traditional banks, shouldn't we encourage or at least allow them to compete? Why is synthetic banking such a concern? Two reasons come to mind: run risk and regulatory arbitrage. Run risk is the risk of customers withdrawing their money en masse from an institution out of fear that their money is not safe or that they may not be able to access it when needed. In 2008, in the financial crisis, it's notable in part because runs on non-banks, such as money market mutual funds and structured investment vehicles, caused as much financial instability as runs on banks. Today, with the rebundling of banking by SBPs, the money held by payments platforms looks less like the spare cash in one's wallet and more like the cash one holds in a bank deposit. At the same time, those platforms are now extending material amounts of credit. On-demand par liabilities mixed with credit risky assets. These are the ingredients that can lead to runs. Deposit insurance, Fed discount window access, and the associated capital, liquidity, and other prudential requirements that have been developed for banks over the years have been designed to mitigate run risk. But those measures can only be effective when the institution is within the bank regulatory perimeter, which synthetic banking providers are not. Reg arb is a second concern. In addition to prudential requirements to guard against runs, banks are subject to robust supervision for safety and soundness, as well as compliance with the host of consumer protection requirements. While fintechs generally are subject to most of the same consumer protection regs if they offer covered products and services, we have seen some fintechs make technical and questionable arguments that their products or services fall outside of the existing regulatory framework. In addition, fintechs are not subject to the same type of regular direct supervision as banks. And the enforcement authority for applicable consumer protection requirements on fintech activities is scattered among various federal and state regulators. These differences create an unfair business advantage for SBPs, which supports their growth and puts pressure on banks to compete. This all leads to a second question. If SBPs are essentially in the business of banking, why don't they just become banks? While a handful have, most have not. I believe this is for three reasons. First, it's easier and cheaper not to. Today, synthetic banking providers can offer bank-like services to their customers through bank partnerships, typically with smaller banks, at a fraction of the cost of becoming a bank. To some, these banking as a service arrangements are a harbinger of the future, where the comparative advantage of technology firms to amass users shifts the bank business model away from customer interaction and towards facilitation. To others, these are simply renter charter arrangements, which allow fintechs to skirt a host of rules at the expense of customer protection and bank safety and soundness. The second and perhaps more important reason why SBPs are not seeking to become banks is because the technology business model is quite different from the bank business model. Fintechs are not aiming to earn net interest margin or fee-based income like banks. Rather, they're focused on creating large networks of users and capturing data, which can be monetized later. This model follows in the footsteps of big tech firms like Facebook, Google, Netflix, and Amazon, and reflects the orientation of the venture capital investors in fintechs. High quality earnings is the hallmark of a safe and sound bank. The fintech business model turns that on its head. Some of the most highly valued tech companies generate minimal earnings or even operate at significant losses for multiple years before becoming profitable. Increasingly, we are finding that we have to consider how to reconcile these business model differences with safety and soundness. The third reason why SBPs have not sought to become banks is because regulators have been unpredictable with regards to chartering new banks and approving fintech acquisitions of banks. I believe that having a clear, shared approach to the bank regulatory perimeter and leveling up our understanding, policies, and staffing related to emerging technologies can help address this challenge. Let me turn now to the second key problem, partial and selectively regulated crypto firms. Today, no crypto firm is subject to comprehensive consolidated supervision. This means that there are gaps in supervision and risks can build out of the sight and reach of regulators. A typical corporate structure will have a holding company over a number of subs. One subsidiary may have a trust bank charter or special purpose license to enable custody of crypto. For instance, New York SPIT license, Wyoming Speedy Charter, or the OCC National Trust Bank Charter. While another subsidiary may have an SEC registered broker-dealer to enable trading. While each of these legal entities is regulated, there will be additional unregulated affiliates under the same holding company, part of the same overall enterprise in which a wide range of activities and risk-taking can take place. Without a consolidated holding company supervisor, that is, an agency able to see the big picture and empowered to oversee all subsidiaries, including the unregulated ones, no one outside of the firm can understand how the group operates and how much risk it is taking. In banking, the need for consolidated supervision was learned the hard way in 1991, when global authorities closed the Bank of Credit and Commerce International, better known to generations of bank regulators by its acronym, BCCI. At its height, BCCI was a $20 billion global bank operating in over 70 countries. It was seized by regulators for money laundering and covering up over $10 billion in losses, which were borne primarily by its depositors. Although it had two licensed bank subs, one in Luxembourg, one in the Cayman Islands, it did not have a consolidated supervisor, and as a result, was able to engage in inter-affiliate transactions to facilitate money laundering and obscure the true financial condition of the group for years. As the comptroller, John Hyman testified at the time, quote, "Early on in my government service, I learned one very important and fundamental lesson. Namely, that those so inclined to manipulate banks for their own benefit find it easiest to do so if they operate between different supervisory regimes," end quote. In short, fragmented supervision enables obfuscation and harm. In the aftermath of BCCI's failure, Congress passed the Foreign Bank Supervision Enhancement Act, or FIPSIA, which barred entry of any foreign bank into the US unless it was subject to comprehensive and consolidated supervision by a home country agency. Foreign jurisdictions did the same, effectively leveling up global banking standards by requiring comprehensive and consolidated supervision for all internationally active banking groups. Today, consolidated supervision for banking groups is taken for granted, and the global banking system is safer for it. In addition to fraud, fragmented supervision can obscure excessive risk-taking. Over the course of 2008, AIG lost $99 billion, $62 billion in the fourth quarter alone after Lehman failed. I was covering AIG for the Treasury Department at the time and know the loss as well. They were driven by a host of factors, but the common thread was their origin, an unregulated subsidiary called AIG Financial Products. Although AIG, the conglomerate, had many regulators, state and international insurance regulators, functional financial regulators, the OTS, there was no consolidated holding company supervisor. No one had responsibility for overseeing AIG as a group. This allowed AIG FP to build up massively risky positions out of the sight of regulators. The resulting bailout of AIG was arguably one of the most controversial steps taken by the US government during the 2008 financial crisis. To build long-term trust with the public and avoid BCCI, AIG type events in the future, large universal crypto firms, especially issuers of highly circulated stablecoins, should embrace comprehensive consolidated supervision. At the same time, federal and state bank regulators should prioritize the development of policies, staffs, and supervisory approaches to bring such firms safely into the bank regulatory perimeter. This would clearly differentiate safe and sound crypto firms from those that are regulated only partially and have a history of control lapses, such as Binance and Tether. In conclusion, in the mid-2010s, the problem that regulators wanted to solve with regards to financial innovation was how to promote responsible innovation. The UK created a regulatory sandbox. Other jurisdictions followed with initiatives to increase regulators' knowledge about innovations and the opportunities and risks they presented. The OCC, for its part, created the Office of Innovation and adopted a responsible innovation framework. These initiatives were broadly motivated by a fear that an inability to bring responsible innovation into the regulatory perimeter would result in widespread irresponsible innovation taking place outside of it. Today, the problem has sharpened, due in part to the pandemic's impact on digital adoption. The rebundling of banking services by fintechs and the fragmented supervision of universal crypto firms pose significant medium to long-term risk to consumers, businesses, and financial stability. My remarks have been geared toward defining these two problems, and in doing so, laying out a vision for modernizing the bank regulatory perimeter. Clarifying this vision is important for several reasons. First, it provides a roadmap for our chartering decisions. Shortly after I took office in May, I initiated a review of OCC bank charter applications and cryptocurrency-related interpretive letters. I indicated at the time that I would be seeking a holistic strategy regarding the bank regulatory perimeter so that individual chartering decisions and interpretive letters would align with and support the broader strategic approach. That review is concluded. In the coming weeks, OCC determinations and feedback to bank charter applicants will be communicated. In addition, the OCC has been working with the Fed and FDIC on a crypto sprint. This is also concluded, and the results will be communicated shortly. The content of these communications on the chartering decisions, interpretive letters, and the crypto sprint will be broadly aligned with the vision for the bank regulatory perimeter laid out here today. Second, clarifying the regulatory perimeter helps focus attention on the most salient questions we must address. How should synthetic banking be defined? What constitutes universal activity for a crypto firm? Should certain crypto activity even be allowed to mix? What adjustments to bank prudential standards and supervisory approaches are needed in order to ensure that such firms operate safely, soundly, and fairly? To answer these and other critical questions meaningfully, federal and state regulators will need to engage technology and crypto firms, academics, community groups, banks, trade associations, and other stakeholders. Third, greater clarity about the bank regulatory perimeter should lead to healthier bank fintech partnerships. Currently, there's an extremely wide range of practice, giving rise to concerns about Reg ARB being facilitated by certain banking as a service or rent-a-charter arrangements. At the OCC, we've begun to increase our focus on the banks that provide services to large fintechs and facilitate synthetic banking outside of the bank regulatory perimeter. This dovetails with the CFPB's recently announced order requesting data from big tech companies to assess the adequacy of their consumer protections. We're also working with the Fed and FDIC in reviewing public comments and finalizing the interagency guidance on third-party relationships, which includes fintech partnerships. And we are deepening our working relationship with state regulators, like New York's Department of Financial Services and the Conference of State Banking Supervisors. An unlevel playing field contributed to the financial crisis of 2008. By leveling up banking and finance today, we can help avert repeating that mistake and create the conditions for responsible innovation to flourish. That concludes my remarks. Thank you, and I look forward to a discussion, Garry.
Thank you so much for for sharing that with us. We obviously haven't had a chance to speak before, but a lot of what we try to do at AFC is very much aligned with what you're saying, which is one, we don't allow any members who are purposely structuring the product as a way to avoid regulation. Our view is that the consumer and the marketplace are best served when there are rules of the road that everyone shares. So yeah. I think we're in the same place. Another thing is we've decided to date not to be engaged in the crypto industry, partly because there's a lot of questions about who regulates which pieces of it. But I will say that I would have told you this even if we weren't on this together. I read your speech before one of the digital asset trades, and having lived through CDS and trying to get JP Morgan and Bear Stearns to explain CDS to me in 2005 at a hedge fund, what you said rang true in terms of being in a world where innovation occurred. Yeah. And then the innovation on the innovation, or the CDS squared version of things, is something where there's a perversion of innovation. And so while I'm not in a position to take a position on all of that industry, for us as a trade, we felt that when we think about the consumer, when we think about how do we interact positive with the regulatory and policy landscape, it wasn't clear, and it still is not clear to me how that would be healthy. So I think there's a lot of alignment there. And then on the charter thing, I know for many of us it would be greatly appreciated some clarity, because we do have a number of members who've applied or have outstanding applications, and then clarity about the partnerships. Because our challenge is we start with a customer, not with a charter. Yeah. And historically, we built a system where you start with a charter, which I think we can blame Alexander Hamilton and for that. And he and Aaron Burr got in a fight over bank charters. I always tell people bank chartering led to a duel. So clearly that's been an outstanding issue for a long time. But the clarity would be very helpful. Yeah. And I guess my question for you is, how can we as a trade, how can we as industry, be a positive actor in that? That's obviously for you all to decide, but how can we be helpful in that process?
So Garry, I think the original approach that you laid out, which is that you are trying to set a standard and not just include everybody and just lobby for things. I think that's a great place to start. That speech I gave at the Blockchain Association, part of what I was trying to tell them, because in the crypto industry, maybe we'll talk about them for a little bit as an example. I was really trying to appeal to who are the adults in the room. It's really important, because they're not everyone's bad. There are a lot of folks out there trying to do the right thing, but there needs to be a force to be able to say, time out, guys. We need to call what we see as good and what we see as bad. And internally, we need to decide that and differentiate. Because if we don't, something's going to happen and others are going to do it for us. And it's I think groups like yours that are really trying to do that, I think are very, very positive. I think that we need to see more of that, and we need to see a bit more of kind of level-headed, objective thinking on things that really put consumer first, financial stability first, like put those as first principles, and then we work back from those as to things. On the chartering, I don't blame either whether it's your members or others for kind of approaching things the way we have, because the landscape is just very confusing. And so I think what I'm trying to do today is to try to say, well, okay, we've got a couple problems now. If we can solve for these problems, that should clarify the landscape so that members can do what they're good at, right? They can innovate and provide this and not have to try to arbitrage various things. That's that's not a good use of people's time.
Right. And I think one of the challenges, having been at Treasury and CFPB and FDIC and FSOC and all those places that a lot of which you've been, is balancing the stability with competition. Because, when I first spent some time at the FDIC, a lot of conversations I would have with folks would be around, well, how many bank failures should be acceptable?
Right.
Where the answer was often 0. And as someone who came from the capital markets, I'd say, well, that can't be the right answer. It seems like the answer of regulators is to not let that be externalized to the system as a whole, or to people who really shouldn't be put at risk. The shareholders of those firms should be put at risk. Depositors of a certain size should be put at risk. But it's an interesting conundrum where we've created a system that conflates stability with lack of failure. And I wonder, in your shoes, sort of how you balance that, because, in standard commerce, failing institutions is part of how it's supposed to work. But in banks, it's a really hard thing to balance.
It is. I don't know if this is a helpful data point or not. I was recently talking to one of my counterparts at the Bank of England, and he noted at the Bank of England, they have a competition. Competition is part of their mandate. So they've got safety and soundness and competition. And so that gives them kind of a greater risk appetite for what you're talking about, the failures. At the end of the day, I don't think we approach these things actually that differently. So even though they've got the competition mandate, I think the way we talk and think about safety and soundness and consumer protection largely is fairly aligned. Because I've done a lot of work with the UK, with the various roles I've been in, and we're very, very similar in that regard. So I don't know if it's such a big difference. We do, competition is a positive force. It just has to be done in a way that's reconciled and consistent with safety and soundness and consumer protection. And I think it can be confusing because we've got this hodgepodgey set of agencies and responsibilities here. And that's why I think it's so important that we cooperate and coordinate. It doesn't help anyone where there's just a lot of forum shopping going on. It's kind of penny wise, pound foolish as a strategy. And the good news is I think there is a lot more appetite for cooperation. We're doing a lot of it now.
Right.
Yeah,
and the one thing I was going to say is, as we're thinking about what partnerships should look like and what is a path to a charter, what advice would you give for our members in the interim, right? Because even if you move with all deliberate speed, you and I have both been in this space for a very long time. Speed, fast is not fast in the normal world, because there are a lot of equities to consider, and there are real consequences. So in the interim, what advice would you provide for us as we try to navigate? Because we have businesses that we run every day with partnerships, for example, and we try to keep standards in place for our bank partners and our other members. So, do you have any advice as we hopefully go to this world of more clarity that you've laid out?
Maybe a couple of things. One is always put the consumer first. I think that if you as a matter of principle, that's a good one. And I think one of the hard things in the tech space is that initially it starts off that way. Initially, that's how you get customers. You don't acquire customers by treating them badly. You get customers by offering a lot of convenience, very at low to no cost. I think problems emerge when later on that strategy becomes, okay, how do we monetize this? And what do we do with this now? And it's a little bit like what we were talking about before, Garry. It's not that first wave of innovation. That first wave of innovation is actually usually quite positive. These are real problems that are being solved. It's the second wave where, okay, how do we make money on this? How do we build off of this? How do we make it bigger, faster, better? That's where I think some of the efforts can kind of lose their way. And that principle of serve the customer first can kind of give way to, well, we need to make money here. We got to monetize. We got to do something. And when you're dealing with other people's money, this is a big deal. Like this is very important that we kind of get this right and not let those developments overtake. So I think that's the primary one. The other is, what I found in a lot of my conversations, like you and I are students of run risk. It's kind of like something that is keeps us up at night. We think a lot about. I found in my conversations with folks in the tech industry, the concept of run risk is just really, really out of mind. It's not something they've ever really contemplated. And as you and I know, when you're in that moment and counterparties are running for no reason that you can discern, you might say it's unfair, there's bad, it doesn't matter. They're running. And I just remember Iron Finance was a stable token. It was, I think, 2 billion. There was a run within a day. And in the postmortem, I think the owners were saying, well, it's not fair because it doesn't matter. It's a run. It's a run. And that's, if it's of significant size and it's interconnected, that becomes everybody's problem. And that's why we have the regime that we have.
No, you're giving me a little bit of PTSD. I remember the morning I went up to my trading desk in New York, and my head trader said, we've just received word that General Electric can't turn over commercial paper. So this is before I came to the Treasury side. I was still on the street, and I said, what do you mean? That's not a thing. Like, I was like, if GE can't turn commercial paper, then no one can turn commercial paper.
That's
and
right.
Then if you can't turn commercial paper, that means someone somewhere is making losses on commercial paper of investment grade firms, and that must be sitting in money markets. And then you start to see that. And yeah, I think that's something that unfortunately you have to live through a little bit.
Yeah.
Also, I think one of the things we work with our members to think about is most of our firms haven't been through credit cycles.
Yep.
Those tend to be far worse than you want to believe.
Yep.
And coming out of the pandemic, something we talked about earlier today, we can't really look to the last 2 years or 3 years to really look to think about how do we underwrite, how do we score,
right.
how do we report, how do we collect? And that's going to create some instability as well, because it's about trust. And unfortunately, too many people put trust in third-party validation of a number or a letter. And if they lose confidence in that, it can be quite difficult. But yes,
you sound like a supervisor, Gary.
well, I was a short seller, which is not that different. But when I came to the Treasury thinking about that, how do you stop that? And obviously in the crypto space, that is a world where the runs can be colossal and catastrophic. So thank you so much for sharing your view with us today. Hopefully we'll get to see each other in person sometime. And please count on us as a partner. Obviously, we won't always agree on everything. That means the system's healthy. But we will hopefully be a partner wherever possible. And if I or any of our members can be of assistance, please let us know. Thank you so much.
I really appreciate the opportunity, and we'll be in touch, Gary.
Great to see you.
Thank you.
Take care. Bye.
Bye.